Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to continue our study on financial statements of banks, and like I promised you, we are going to solve a question, a very detailed and practical question together. And like I promised you, we are going to solve a question, a very detailed and practical question, okay? And all of us, I'm sure by the end of the question would appreciate. But mind you, before you would be able to understand this question very well, you need to have some understanding from published financial statement of companies that I have already treated. Because I'm not going to take time to explain the additional information items into details because they are almost the same. The standards are same here. There will be something on PPE, investment property, IAS 12, income taxes. You need to apply the knowledge from all those standards in this same financial statement that we are going to prepare. And so the assumption is that before you are here to learn this, you have already learned the standards and you also know financial statements for the companies that are into trading and manufacturing. Okay, so I'm not going to waste my time. I'm going to read the question with you. We analyze together and then we solve it. All right. The trial balance below was extracted from the records of FOG Commercial Bank as at 31st December 2019. So you have your currency as Ghana cedis and you have 3 zeros up for both the debit and the credit side. So the items on the trial balance. Interest income is 4,950, meaning that is 4.950 million. That is what it means because there are 3 zeros up. But I'm going to ignore the 3 zeros up and just read them as they are. Interest income 4,950. Interest on customers' deposits is 850. So you see the interest income is there and the interest expense has been written as interest on customers' deposits. That is the interest expense. Please take note. We move on. Net commission and fees income has been given as 900 cedis. Then gains on foreign currency transactions. And then dividend income. Now, gains on foreign currency transactions are other operating income. Remember that I told you that there are 3 main classes of income: the interest income, the commission and fees, and then other operating income. These are the 3 classes of operating income. There could be another source of income that is not part of the main operation activities, and we may encounter some in this question. But when you see something like the gains on foreign currency transactions, those ones are related to operations, so they are other operating income. And then if you see something like dividend income, that is also coming from investment of liquid funds. That is also operating income. So you can see that gains on foreign currency transactions, 40 cedis, is an operating income. And then dividend income of 30 is also an operating income. Now, the interesting thing is that you see these 2 operating incomes, we are not supposed to present them separately on the financial statement or the statement of profit or loss. So we need to combine them and any other that we will find. So we are going to have a workings for operating income, other operating income, and then we sum the 2 of them or any other that we will find. We sum all of them up and then we indicate the note number when we are taking the summarized figure to the statement of profit or loss. So that is what I'm trying to let you understand. Then we move on. There is operating expenses of 2,400. Now, the fact that they've given you operating expenses doesn't mean that that is the only operating expenses. Sometimes you find other operating expenses and then you need to sum all of them up and take the final figure. So you're going to do a lot of workings. Okay, so if we see any other operating expense, we will add that. So here we have operating expenses to be 2,400. Directors' emolument, 20 cedis. Directors' emolument is also part of operating expenses. So take note, we'll add that. And then there is auditors' fees of 40. The auditor's fees will also be part of operating expenses. So please take note. These things are understood from the video that I have already done on a final account for publication. You can go back and refer to those ones. So auditor's fees is part of operating expenses. Dividend paid will be part of the statement of changes in equity. We will use that under changes in equity. Then there is a loan impairment provision. You let me continue to read, but as I read, I will explain. Loan impairment provision, 1st January 2019, and there is a note on that, note 4. So when we get to note 4, we understand the loan impairment provision is 410, but that is an opening balance, okay? Now, provision for loan impairment is treated the same way we deal with the provision for doubtful debt or irrecoverable debt. We compare and take a difference, whether there is an increase in provision or decrease. And I told you that the loan impairment here that we are talking about is what I call the impairment of financial assets on the format that I gave you in the previous video. So please take note. We'll read the notes for and then do the workings appropriately. Then there is rental income from investment property, which is note 3. That one to go and read that, but the figure there is 90. So the rental income, we have taken rental income from investment property. Now, this rental income that we have taken from investment property, it's not the income that is related to operations. Remember that there is operating income and there is other income. This one is from the rent from that we have gotten from our investment property. And as a bank, our main or our core services is not to rent our property to customers or whoever that is tenants. Yes, so it means that that income that is coming from the rental of investment property will not be treated as part of operating income. But you realize that when we go to the gain on foreign currency transactions, I said it to be part of operating income because foreign currency transactions are part of a bank's operations. Dividend income, investments are part of a bank's operations, but rental income from investment property is also income, but we'll call it different. It's not part of operating income. So when we are doing the workings, okay, we are going to do workings for other operating income. List those items and sum them up. Then we're also going to do for other income that is not from operations, and then we'll sum them up as well. So that on the financial statement, we'll show other operating income separately from other income. So please take note. So rental income from investment property, 90. However, there is a note attached to that. So we'll read it at note 3. Let's move on. Then corporate income tax, that is the current income tax, is 11 and it's at the debit side. So that one is also at note 2. So we'll go and read the note on tax. So we move on. Income surplus, 1st January 2019, that is the opening balance for income surplus. There is capital surplus also at the beginning of the year. All those ones are opening balances for the statement of changes in equity. And then statutory reserve also has an opening balance, but there is a note attached, note 5. So we'll also go and look at what they are saying about the statutory reserve. Then we move on. There is stated capital, 50,000 equity shares on 1st January 2019, and the value is 100,000. So the 100 is written there. Then we continue. Cash on hand, 340 cedis is cash. And then balances with central bank. Balances with central bank is 3,050. Now, let me say something about this as well. You see that when I was giving you the format for the statement of financial position, I told you that when it gets to the assets, we are going to list it in the order of liquidity, and we are going to begin with the most liquid, meaning we are starting with cash. Now, when I mentioned cash in hand, I also mentioned that it will include cash balances with the central bank. Now, in this trial balance, we have cash in hand to be 340. Then we are also told that there is cash balance with the central bank of 3,050. So on that first line where we have cash and short-term funds, we are going to combine both the cash in hand and the cash balances with the central bank together as one figure. And that means we need to do workings for it in the notes. Every figure that you add up to bring to the accounts or statement, financial statement, you need to show the addition in the notes. So the note is there for the workings that you are doing. As long as you are not taking it there individually or in isolation, but you are combining, you show how you did the combination in the notes to the financial statement. So we combine those two figures. And then we have investment in government securities, 10,900. That one is also a current asset. Remember, I spoke about that as well. And then we have Investment in listed financial instruments. So this one is not a short-term investment. It's an investment in a they didn't classify the type, but once they are financial instruments, they are investments, and we would treat them as assets. Okay, and then receivables from other banks. That is what I call due from other banks. So these ones are also assets. So we are going to treat them. Once there are no notes on them, we are free to pick the figures. Then payables to other banks will also be treated as a liability. Then overdrafts, loans and advances. Those ones are loans and advances, and that is also treated as an asset for the bank. Then we have sundry receivables and prepayments. So other receivables, that will also come as an asset. And then there is property, plant, and equipment. PPE note 1. So it means that there is a note on PPE that we are going to read and resolve. But the value of PPE here is 1,240. And then accumulated depreciation on PPE as at the beginning of the year is 410. So meaning that both of them, one represents the cost of PPE, the 1,240 represents the cost of PPE, and 410 represents accumulated depreciation. We are going to look at that. And then there is investment property, 240, but there is a note on that, note 3. So we'll read that as well. Then customers' deposits. Customers' deposits is 24,530. Remember that I have told you that customers' deposits with the bank will be liabilities. Okay, so we'll treat them as such. The last one on the trial balance is expense, trade payables, and accruals. Expense, trade payables, and accruals. So that will also be a liability. Trade payables are also liabilities. Now, so we have the total of the trial balance. And then we move to the additional information. This is where I want you to pay attention, because as we read, I'll explain, and then we'll begin to solve the question by starting with the workings. We'll look at the workings before we present the statement. So the following additional notes is relevant. 1. Property, plant, and equipment. So this is the note on PPE. Property, plant, and equipment is analyzed as follows. So there is cost and there is accumulated depreciation column, and there is a rate of depreciation. Land and building, the cost is 450. Now, you see, let me show you something. You see that if you go back to the trial balance, where we have property, plant, and equipment under cost, the total cost there is 1,240. Now, if you come to the additional information, there are 3 assets that make up the property, plant, and equipment. We have land and building, computers and equipment, and motor vehicles. If you add the cost values for the 3 of them, it should give you what you have on the trial balance. So if you take land and buildings, the cost is 450. Computers and equipment, the cost is 750. If you add that to, that gives you 1,200. And then motor vehicles is 40. So the 3 of them will give you 1,240. Let's go back to the trial balance and check. Property, plant, and equipment note 1. You see that the cost on the trial balance is the same, 1,240. So that is the implication. So whatever is in the additional information is only explaining what is in the trial balance, but we will still read. Now, also look at the accumulated depreciation for the property, plant, and equipment. Land and buildings accumulated depreciation is 90. Computers and equipment is 300. Motor vehicles is 20. If you add those 3, 90 plus 300 plus 20, it's going to give you 410. So let's go back to the trial balance and check. Accumulated depreciation of PPE as at 1st January 2019 is 410. So it's the same figure. So what we are trying to say is that those things that are down there are not new. They are only explaining the information that you already have in the trial balance. And then let's go back and see. There is a rate of depreciation for each of them. Now, land and building, the rate of depreciation is 2% per annum, straight line method. Computers and equipment, 25% per annum, straight line method. And then motor vehicles is also 25% straight line method. So that is it. Now let's continue to read. So it means we are going to use this figure, these percentages, to calculate depreciation on the figures. And once they are all straight line, it means they are on cost, except the ensuing information gives us another different twist of it. So let's continue reading. Still on PPE. The land and buildings were acquired on commencement of business in 1st January 2009. So it means that the land and buildings were acquired 10 years ago, because we are working in 2019, but it was acquired on 1st January or in January 2009. That is 10 years ago. So please take note. Let's continue. There have neither been further acquisition or disposal since then. The directors caused the properties to be revalued in January 2009. So 10 years after the purchase, there is a revaluation. The valuers assigned value of 400,000, but advised that the estimated remaining life should be maintained. The directors wish to incorporate this with this valuation. The directors wish to incorporate this valuation in the 2019 financial statement. Now, let me explain all that you see there in the English. Now, all that you see there is related to only the land and buildings. Now, the land and buildings was bought in January 2009. They didn't tell us that, but we know the cost is 450. Okay, so it was bought for 450. Now, take note of something. In January 2009, up to January 2019 is 10 years. Exactly. Now, if we are considering up to the end of 2019, it will be 11 years. But thank God the revaluation was done in January 2019. Now, the revaluation was done to 400 cedis. I want to show you something. We have not started solving yet. We are analyzing the question. Now, 400 Ghana cedis, that is the upward revaluation. They have decided that this revaluation should reflect in 2019 financial statement. But the financial statement will be to the year ended 31st December. Now, fair enough. As at the time of revaluation, we need to calculate to see if there was a revaluation, a gain on revaluation or not. Okay, now we'll come there. We are also told that they advise that the estimated remaining useful life should be maintained. Now, first of all, they didn't give us any estimated useful life in years for the land and building, because we are talking about the land and building. That's the property they are talking about. They didn't give us any estimated useful life, but it is in there that you can find. We are told that the depreciation rate for land and building is 2% per annum. Now, if you buy an asset and the rate of depreciation is 2% per annum on straight line method, do you know the implications? It means that 2% per annum, how many 2% do you have in 100%? You are going to calculate 2% times 50, because if you divide 100 by 2, you are getting 50. So once we see 2% per annum on a straight line, indirectly it also means that the estimated useful life of the property is 50 years. That is the meaning. Some of these things, it will not be written directly in the question, but you should understand that once you are given a depreciation rate of 2%. So let's test ourselves right now. If your depreciation rate is 10% per annum, what is the number of years of the asset? 10%. How many times is 10% going into 100? It's 10. So 100 divided by 10 gives you 10. If your rate is 20%, 100 over 20 gives you what? 5. So once it's 20% per annum straight line, then the estimated useful life will be 5 years. So these are the dynamics on how to calculate the estimated useful life of an asset. So now, it means that the useful life of the asset is 50 years at the date of purchase. Now, 10 years has gone. So if it is 50 years, you can either calculate 2% of this, or you say 450 over 50 years. Meaning that annual depreciation charge is 9 cedis per annum. You could have just applied 2% on 450 and you still get 9. Okay, now annual depreciation charge is 9. So it means if you want accumulated depreciation of the asset for 10 years, it means that the accumulated depreciation will be 9 times 10 years. And that's going to give us 90 cedis. Now, why am I looking for accumulated depreciation? The asset is being revalued. And to get the surplus or loss on revaluation, you need to compare the fair value, the new fair value, with the carrying amount as at the date of revaluation. And the carrying amount or the net book value is the cost, initial cost minus its accumulated depreciation. Therefore, at the date of revaluation, the carrying amount of the asset is 450 minus 90, which is 360 cedis. So as at 1st January 2019, the asset had a net book value of 360 in the books. And we want to find the gain on revaluation. So the profit or revaluation surplus is going to be 400 minus 360, and that is 40. So it means that when the revaluation was done, there was a revaluation surplus of 40, which we are going to deal with. We are going to treat that as part of the statement of changes in equity, because that is a revaluation surplus from the property, plant, and equipment. We'll get there. However, let me show you what I'm concerned in letting you understand. Now, it means that in this year, we are now going to calculate depreciation. Going back to the information, we are told that the directors caused the property to be revalued in January 2009. The valuers assigned a value of 400,000. but advised that their estimated remaining useful life should be maintained. Now, as at the date of revaluation, 10 years had elapsed from the 50 years. So if the useful life was 50 and at the date of revaluation, 10 years is gone, how many years will be left? You see that it will be left with 40 years. So this year, we are going to depreciate the asset again because the revaluation was done at the beginning of the year. But now the remaining useful life is what? 40 years. If you take 10 years out. So it means that the depreciation will now be 400 over 10. Over 40, sorry. And that is going to give us 10 cedis. This is not the workings. I'm just analyzing the question because I have not finished reading the question. I want to finish reading the question and analyze it like this. And then I will now start solving it. So please take note. I need you to understand the dynamics of what we are doing. So this is just for you to understand the information that they have put there. So we are going to use this 40 and this is also going to be the depreciation. But when we are preparing the statement of financial position, the new fair value will go in with PPE. And I'm going to prepare the PPE schedule for you to understand when I'm solving the question. But this is just for you to understand the information. So I move on to the next additional information. I'm going to clean this. We are still analyzing. When we are done analyzing, then I'll solve the question. But I want you to understand it first. Okay. Let's look at the next information. Additional information 2. There was neither current tax liability nor current tax asset as at 1st January 2019. So we are good to go. During 2019, the company paid 100,000 for corporate tax on interim assessment. That is what we find on the trial balance. If you go to the trial balance, you see that we have corporate income tax, which is 100 on the debit side. That is what they are telling you that they have paid for the year. Okay, so that one was on an interim assessment. So we move on. They have already paid that. The bank is subject to 20% corporate tax, and the company adopts nil provision for deferred tax. Now, this one is the easiest tax information you can get in any published account question, whether for banks or for manufacturing companies. The reason is that normally before you get the tax value to be included in the statement of profit or loss, it is your current tax adjusted with the opening current tax for asset or liability plus the movement in deferred tax. And the current tax is either a self-assessment provision that is made or a percentage that is calculated on your profit plus the movement in deferred tax. We are fortunate that in this question, there is no over or under provision from the previous year, which is the opening balance of tax assets. We are told that there was neither current tax liability nor current tax asset at the beginning, meaning that no over provision or under provision from the previous year. If you have really studied IAS 12, you understand what I'm saying. Then also we are told that they adopt a nil provision for deferred tax. So it means there is nothing like movement in deferred tax. So the only thing we need here is the current tax, which will be calculated, and here it was not given to us as a value, so we are going to calculate it as a percentage on the profit. So whatever profit you have, you apply 20% on it as your tax expense for the year. But remember that we have already paid 100 cedi tax, so if we calculate and we have more than 100 cedis, then it means that the difference is not paid. It will go again as a liability. But if we get less than 100 cedis, then the excess will come as a tax asset. So please take note. We will do that when we are solving the question. Then we move on. So the third additional information is on investment property. We are told that the investment property was acquired in January 2019. So this year, we just acquired it this year. The rental income from investment property of the 90,000 Ghana cedis relates to 3 years period ending 31st December 2021. So you see, we are told that the investment property, IP, was acquired on 1st January 2019. And that is the same year in which we are preparing this account. And in the trial balance, remember we saw something like a rental income from investment property, which I told you that it is not part of operation income. It is other income. And the value was 90 on the trial balance. But you see that they've written it as 90,000 in the additional information, because in the additional information, we don't put 3 zeros up. So they write it in full. Now, this 90 or 90,000, we are told that it is for a period of 3 years, ending 31st December 2021. So it means that this 90,000 income relates to, it's a rent. In other words, the tenant has paid 3 months rent in advance. Sorry. So in other words, the tenant has paid 3 years rent in advance. So 2019 rent is there, 2020 and 2021. But we have received all on the trial balance for 2019. But remember the accrual concept. When we are preparing our financial statement, we cannot recognize unearned income or unearned revenue. So we can only recognize that which pertained to 2019. And the difference that we have not yet earned will go as a liability, as unearned income. So what we are going to do is that, because this 90,000 rental income from investment property relates for 3 year period, we are going to divide it by 3 years, and we are having 30 per annum. So only 30 will be recognized this year as other income. The extra 60 that remains will go as a liability, because we are not yet in the period that we have collected the money. These principles are easy for you, I am sure. We continue to read the information on investment property. The bank adopts fair value model in subsequent measurement of the investment property, and fair value assessment as at 31st December 2019 puts the valuation at 250,000. Now, this time we are looking at the value of the investment property itself. The investment property was acquired for 240, or with 3 zeros up, so that is 240,000. Now, you bought it at a cost of 240. Sorry. And then at the end of the year, you have revalued it upwards. So there is a fair value at a value of 250. This 240 is in the trial balance. You can confirm with me. So we go to the last but two statement information on the trial balance. Investment property note 3, 240. Now, we are told it has been revalued upward to 250 because it has adopted the fair value model for subsequent measurement. It means that the revaluation has caused an increase in the value by 10. This 10 will also be treated as other income. This is not PPE, so you can't take it to the PPE schedule. You know, that is what most people get confused. This is investment property. If it was PPE, we'll take it to the PPE schedule. But this one is not PPE. This one is from investment property. And that is not part of the main operations. So we are going to treat this as other income. So just as this 30 is other income, the increase in the value is also other income. So the rental income pertaining to the year, and then the increase in the value of the investment property, the two of them will combine as 40, and we will take it as other income. I'm going to show that. Don't worry, I'm going to solve it systematically, show all workings in a very nice, organized way for you. But I need you to first appreciate the concepts from the additional information that we are reading, and then from there we'll solve it together. Okay. And then let's continue to read the next additional information. Ivan, loan impairment provision at the end of the year, as at 31st December 2019, is to be increased to 510. Now, loan is a financial asset to the organization, and I told you that the impairment of financial assets will go as an expense to reduce the profit on the statement of profit or loss. However, the treatment of loan impairment is just like that of the provision for doubtful debt or allowance for recoverable debt. What we do is that we compare to see if there was an increase in provision or a decrease, because the banks continue to give loans every year. So every year they do impairment tests, and they always create a provision for impairment loss of their financial assets, which is including the loan. Here it is more specific that impairment test on loan, and we are told that the provision for loan impairment for this year is 510. That is the loan impairment provision. So the closing balance for loan impairment provision is 510. Let's go to the trial balance and check the opening balance for loan impairment provision. Loan impairment provision as at 1st January 2019 is 410. That is on the credit side. So there was an opening balance of 410. And now there is a closing balance of 510. So the difference means that there is an increase in provision of 100. This increase in provision will go as an expense. If there was a decrease in the provision, then it would have gone as income or other income. So please take note. But here there is an increase in provision, so it will go as an expense in brackets on the financial statement. But this whole figure of 510 will go as a current liability, or it will either go as a current liability, or normally it reduces the value of your loan assets or your advances and loan to customers. So this is a current liability, but we don't take it as a liability. We rather reduce the loan's value, just as provision for doubtful debt will reduce the receivables figure. The same way that provision for loan impairment will reduce the value of loans on the assets list on the financial statement. So that is how we treat that. Now let's look at the last three, and then we'll solve the question. Now, additional information, Vin. In compliance with the Banking Act, 12.5% of profit after tax is to be transferred to statutory reserve. So that one is just an information that when we get the profit after tax, the Act says that every year 12.5% of your profit should be transferred to the statutory reserve, and we are going to do that on the statement of changes in equity by transferring. So when we get there, you see. Then the last but one. On 15th November 2019, the directors paid an interim dividend of 40 pesos per share. No further dividend is recommended for the year. So yes, there was a dividend payment of 40 pesos per share, and that is going into the statement of changes in equity. We are going to multiply 40 pesos by the total number of shares, and then we will subtract from the income surplus balance. So that is also no big deal. The last one says that in order to satisfy the central bank minimum stated capital requirement, the shareholders at an emergency meeting on 24th December 2019 approved a bonus issue of 1 share for each one held out of income surplus to be credited at the current market price of 5 cedis per share. This decision is to be reflected in the 2019 financial statements. So this one is also going to statement of changes in equity. It is actually going to increase the stated capital because they are issuing bonus shares to existing shareholders at 1 share for each one held, but it will be financed from the income surplus. So this will be like a transfer from income surplus to pay the bonus shares. That will eventually increase the stated capital, which I'm going to show you when I'm preparing the statement of changes in equity. Now let me just give you the requirement briefly, and then we'll look at the question in the next video. Required. Prepare the income statement and statement of changes in equity for the year ended 31st December 2019, as well as statement of financial position as at 31st December 2019 in a format that accords with the relevant legislations and the international financial reporting standards. So this is the requirement of the question. We are supposed to prepare the statement of profit or loss. Of course, we prepare the statement of changes in equity, and then we prepare the statement of financial position. Then I will show the notes. In fact, the notes to the financial statement are supposed to come last after you have prepared your statement. But you need to prepare that first before you can prepare the statement. So what I'm going to do with you here is that I'm going to do the workings, that is the notes first, and then I'll prepare the statement as well. But in an exam situation, you can leave a space for the statement, go and prepare your notes, and then come back to finish it up. But yes, that is it for now. I'm not going to take my time. Some of you have been complaining about the length of the videos, the earlier video. That is why I'm trying to reduce the length of the videos. And so I'm going to end the part 2 of this lesson here after analyzing this question. Now, I'm going to quickly follow up with the part 3. I'm actually recording it now and I'll upload it soon, so that you go and then continue where I'm solving this question. So this video is just for the analysis. The next video will be to solve it, where I know that we have already analyzed, and so I'm going straight to the point. Remember to subscribe to the channel if it is your first time. Share this video and let others also have a benefit. And until we meet again for part 3, it's bye for now. Thank you.